The markets are looking pretty scary these days, and so I try to think about what you as an investor might be wondering and what kind of questions you might be asking. I thought of three, which are first, why are the markets falling? Second, how low can we go? And lastly, should you be scared? And in today's video, I want to answer all of these questions. And so jumping into today's agenda, I'll first explain why the Fed may be trying to engineer a recession. I'll then provide some analysis on previous recessions. And lastly, I'll share with you my personal thoughts and a rough game plan you can use as a guide. A few quick things before I get started. First, if you like what you see in today's video and want to get buy-sell alerts whenever I make a trade and get access to my full stock and crypto portfolio, feel free to check out my Patreon down in the description below. Second, please remember that I am not a financial advisor, so please treat all content as for education and entertainment purposes only. And lastly, shout out to our sponsor for today's video, Composer, for helping make this video possible. Alright, with that said, let me first answer the question of why the markets are falling by explaining why the Fed is engineering a recession. Now look, usually I'm pretty optimistic about the markets and tend to lean more towards being a bull rather than a bear. And I'm not trying to just spread fear around by saying that a recession is coming just out of nowhere. There actually have been a lot of articles talking about how the Fed is potentially trying to create a recession or cause one to happen. And I'm sure you might be wondering, why? Well, the first thing you need to know is that the Federal Reserve, aka the Fed, is the United States central bank, and it has two mandates, which is to minimize unemployment and to control inflation. Unless you've been living under a rock, you probably know that inflation is running extremely hot at over 8%, which is the highest we've seen in decades. And let me explain why the Fed cares so much about inflation. Inflation is dangerous because it can become a self-feeding cycle. If inflation goes up, the value of a currency goes down, which encourages people and businesses to spend quickly since their cash is decreasing in value. This results in an increase in demand, which can eventually outstrip supply, which causes prices to rise further, thus increasing inflation, and the loop continues. High inflation can cause something called stagflation, which is when growth slows, demand falters, unemployment rises, and inflation keeps climbing. And in a worst case scenario, there can be hyperinflation, which is when the currency essentially becomes worthless and people start to burn cash to stay warm because it's cheaper than firewood, which is a true story of what happened in Germany. The inflation we're seeing today is caused by many factors, but to me, the five main ones include the following. Supply chain issues caused by COVID-19, especially with China's zero COVID policy. Pent-up demand caused by the pandemic. The $5 trillion in economic stimulus that pumped massive amounts of cash into the economy, the Russian-Ukraine war, which has removed Russia's supply of oil and gas from the market, which has caused oil and gas prices to soar and increase the cost of doing business, and lastly, historically low interest rates, which made it cheap for companies to borrow capital and didn't keep inflation in check. The main tool that the Fed has to combat inflation is raising the federal funds rate, aka interest rates, and let me explain how this works as well. Federal funds rate is the rate at which banks and other financial institutions lend to one another. And when this rate increases, banks now have to charge higher rates for things like mortgage loans, credit card APRs, and other consumer and business loans. And this means that consumers now have less money to spend because their bills have increased, resulting in less consumer demand. And companies have higher costs of borrowing, which decreases their output and can cause many to lower their prices in order to get customers buying again, thus overall decreasing inflation. As a policy response to COVID-19, which was destroying demand, the Fed lowered interest rates to historic lows, which is a major contributing reason inflation is running so hot today. And so now that you understand the fundamentals, let me now explain why many believe that the Fed is engineering a recession, which will help explain why the markets are falling. Jerome Powell, also known as Papa J. Powell, is the Fed's chair, and in his public statements back in March, he gave tribute to one of his predecessors, Paul Volcker, who was known for slaying inflation in the 1970s and 80s by raising interest rates to historically high levels, which caused a recession and took down the stock market and economy. Following in Volcker's footsteps, Jay Powell has said that he plans to keep raising interest rates until inflation comes down, and many estimate that the federal funds rate will rise to about 2.5% to 2.75% by the end of 2022 and likely go higher in 2023. This hawkish stance by the Fed seems like it's already working because a recession is usually defined as 2 straight quarters of declining GDP growth, and the first quarter of 22 has already seen a 1.5% decline, and quarter 2 will likely see a decline as well. And so, in anticipation of a potential recession, investors have been aggressively selling riskier assets, which has resulted in a bearish cloud that currently hangs over the markets. And if you want an even deeper and more technical explanation as to why interest rates and inflation affect the markets, feel free to check out this video I made a few days ago. And so, we're in a pretty tough market right now, and you may be feeling a lot of emotions as things are going up and down. But the best way to invest is actually to take emotion out of the equation and to invest systematically. For example, quant funds like Renaissance Technologies uses sophisticated algorithms, machine learning, and AI in order to take out human intervention in the process of buying and selling securities. And what if I told you that you could have access to that kind of tech? This is where Composer comes in. Composer is a platform built by data scientists, investors, and quants that help you automate your trading by allowing you to build trading strategies called symphonies. Get it? Composer, symphonies? You can also invest in symphonies that are already created, and let me show you one that I particularly like and have put some money into called the Buy the Dips Nasdaq 100. As you can see, there's a graph that shows performance and an overview of the symphony. Then if you scroll down, there's more detail about the strategy. And so, for example, what this symphony does is when QQQ drops by 5% over 5 days, the symphony buys a leveraged version of QQQ, but if not, your money is put into bonds. There are a lot of different options and trading strategies you can create on Composer, and I think they're a really cool and unique platform that I haven't really seen before, and it really allows you to take out emotion out of trading. And so if you want to check them out, feel free to use my link down in the description below. Next up, let me answer the question of how low we can go by analyzing previous recessions. I took some time to look at the past 8 recessions and gathered some key data points, and I won't go through everything here, but you can pause the video in case you want to examine anything more closely. One thing I want to note is that the length of a recession is super variable and challenging to predict, but on average, they last for 10 months. And so if the recession has started in Q1 of 2022, then in a base case scenario, the recession may last until around the end of 2022. I also want to touch upon unemployment, which today stands at around 3.6%, which sounds like it's a good thing since it's low. But according to a study done by Larry Summers and Alex Domash, the combination of greater than 5% inflation and unemployment of less than 4% makes a recession 100% likely based on historical data going back to the 1950s. And as an ominous sign, we're already seeing signs of unemployment increasing, with the tech sector recently making tons of layoffs. I then took a look at how much the S&P 500 fell during each of these recessions, how many days we had a bear market, and then how long it took to get back to the prior peak. Now I know there are a lot of numbers here, so here's the punchline. First, it's been 151 days off our most recent peak of $4,766 from last December, and comparing to the average length of bear markets during recessions of 405 days, this implies we could have about 250 days left until we hit bottom, which could be around February 2023. Second, I took the minimum, average, and max drawdowns from previous recessions and calculated an implied price of the S&P 500. As of the filming of this video, we're already 13% off our all-time highs, so we're near the minimum. But as a base case scenario, the S&P 500 could fall another 25% to around $3,100. And if things go absolutely haywire, we'd go down 50% to the low 2000s. Now, of course, you can't just look at historical data and expect it to happen exactly the same in the future. But as they say, history doesn't repeat itself, but it does often rhyme. And so hopefully this provides you a relatively good guide of how low things can actually go. That's a good segue into the next section of the video, which is answering the question of should you be scared? And I'll answer this by sharing my own personal thoughts and game plan. Nothing is for certain, but I do think a lot of data points and the entire macro environment right now is really pointing towards a recession, which can sound scary, but I think you can also view bear markets as a really great way to build wealth. My current view right now is that I would not be surprised at all if the S&P 500 fell to the low 3000s, which would be the average drawdown for a recession like I covered earlier on in the video. Now, I cannot stress enough that nobody knows where the markets are going to go, and if they do tell you that they know for sure, then they're honestly just a liar. But anyway, the point that I'm trying to make is that in case the markets do go down, I feel like you won't be as scared as an investor if you kind of know what your game plan is if the markets keep going down. And let me share with you what I plan to do if the S&P 500 keeps falling. First, I'm trying to remain patient and want to see if the S&P 500 falls to around 3,500. And if that happens, I would pretty aggressively start buying with about 50% of my cash. Second, if the S&P 500 falls further to around 3,000, I would pretty much put everything I have into the stock and crypto markets because you can just never predict when a rebound will come. And when it does, it'll come back really hard and you don't want to miss that. Lastly, there's always a chance that some black swan events make the markets go haywire, and if the S&P 500 heads to 2,500 or below, I would continue to put all the cash I earn into the markets, but with a lot stronger conviction that this would be near the bottom. With all this said, I do want to add 3 important caveats. First, many assets like high growth stocks and crypto have already fallen by more than 50 to 80%, and so there may be assets that you want to buy on a case-by-case basis, regardless of how the overall market performs. Second, crypto was founded in 2008 and has never been in a recession. In the past few downturns, Bitcoin has fallen as much as 80% and other altcoins more than 90%. And so if things take a turn for the absolute worst, the crypto markets could fall way harder. And if they do, I would still be a buyer. Lastly, please note that the plan I laid out earlier are just rough general guidelines, and there's always a chance that policy changes or other factors can cause the markets to rebound. And so it's always important to stay invested in the markets. For example, news just came out that inflation could be slowing, but we don't really know for sure what's going to happen until more inflation data comes out. And on the flip side, other events we don't currently foresee can always bring down the markets like it did in 2008. And so going back to our question of should you be scared? I think if you don't know what's happening with the markets, then things can be really frightening, and a recession can also sound really scary. But hopefully throughout this video, now you understand why the Fed is potentially engineering a recession. You also now know what previous recessions look like, so you have a little bit more visibility about what could potentially happen. And lastly, you have a general guideline of what you can potentially do if things keep falling down. And I'm pretty confident that in the case that we do have a falling market and a potential recession, then if you're invested in the long haul and you're able to buy stocks and crypto and other assets at a discount, then when that bull market does return, you'll be a much more happier investor. And so stay strong, my friends. We will get through this bear market together. And if you have any questions, let me know down in the comments below. And let me know if you think I'm being too bearish or for whatever reason you think that there are much more bullish signs and signals that are out there. And also wanted to give you guys a reminder to check out Composer. If you want to automate your trading, feel free to also check out my Patreon down in the description below if you want to be a part of the Rare Liquid community. And lastly, I'm sharing a lot of my different thoughts about career and investing on my TikTok these days. So feel free to check out that and my Instagram if you're interested. And with that said, thank you so much as always for watching. Hope to catch you in the next video. Thanks so much and peace out.